Okay, back to required reserves. Let's say we have a Bank of Chaffee that currently has $5 million in total demand deposits and has $1 million in total reserves. So let's look at three different possible required reserve ratios and how that would affect this bank. So total reserves, total reserves are $1 million. I already made this error. How nice. $1 million, $1 million, $1 million. Deposits are $5 million. So I have $1 million in reserve right here. And if the ratio is 2%, we apply the 2% to the $5 million up here. So at $5 million, times that by 0.0202, at 0.1, that'd be 100,000. If it's 5%, you take 0.05 and times that by 5 million, you get 250,000. And at 10%, well, 10% that'd be 500,000, right? 0.1 times 5. So how does that affect excess reserves? We have $1 million in total reserves. That doesn't change based on the required reserve ratio. All that changes is the required reserves. So total reserves stay the same, required reserves get higher. So you take total reserves minus required reserves, and that's going to be $1 million minus 100,000. Their excess reserves are 900,000. We have a rate of 5%. That increases the required reserves to 250,000. 1 million minus 250 will give us 750. And if they have 1 million, again, total reserves, and now the required reserves is higher, and there's less excess reserves, then I have to take half of it, right? So that'll leave us with 500,000. Now, the reason why this is a very powerful tool is that it does two things. It affects bank excess reserves, which is what open market operations does, but it also affects the money multiplier, which open market operations does not do. So here we have the money multiplier, 1 divided by the required reserve ratio. So here it's 1 divided by 0.02, 2 cents goes into $1 50 times. Then if the rate is 5%, 1 divided by 0.05 would be a nickel goes into $1 20 times. And 1 divided by 0.1, a dime goes into $1 10 times. So you can see when excess reserves is going up, the money multiplier is going down. And now the potential change in the money supply, if we take your we take your excess reserves, we times that by the money multiplier, we get the we get the potential change in M1. So if you take 900,000 times that by 50, we get $45 million. So potentially, if this bank will loan out all $900,000, you times that by 50, you get a potential increase of $45 million. If the ratio is 5%, we take less excess reserve, 750,000, multiply that by a lower money multiplier, and we have 15 million. And then at a rate of 10%, we have less excess reserves, that would be 500,000, times that by 10, and you get 5 million. So you can see how powerful a tool it is. By raising the rate, not that much, we drastically lower the money potential, creating the potential money creating potential of this bank by quite a bit. And if you multiply this by all the banks out there, because this affects every single bank. If the Fed buys bonds, you only buy from that one bank. Here, with one slight change, they affect every single bank in the entire country, and that affects everyone's excess reserves and affects everyone's money multiplier. Very powerful tool, which is probably why the Fed does not use it that often, because it has a big impact on the economy. What they like about open market operations is it's more of a surgical instrument. They can pinpoint exactly how much excess reserves they want. This is a very blunt instrument, and therefore they, again, can use this if they need to, but normally they don't use it that much. Again, the last time it's been changed was decades ago. So right here, if the required reserve ratio goes in the other direction as decreases, banks must hold less of the total reserves as required reserves, and that would cause excess reserves to increase. That means there's more money for loans. Again, this is when the rate goes down. That affects money multiplier as well. It increases it, which increases the money creating potential. All of this is designed to increase the money supply, to again drive rates down, and again to fight recession. If the rate increases, just the opposite, is that was my example just showed you. This example here. So if they raise the rate, that would increase required reserves, therefore excess reserves will go down, less money for loans. In addition, it also drives the money multiplier down as well, which decreases the money creating potential, so it has a double impact. It's twice as powerful. High rates of interest will result, and this is designed again to fight recession. This is again designed to fight inflation. So favorite tool, open market operations. Use it probably daily. Least used tool, very powerful though, is required reserve ratio, and the weakest tool is the discount rate. Now, the last part of this lecture, I want to talk about things the Fed is doing differently now. This is now non-traditional monetary policy. And so since about 2008, and ever since then, they've been doing things they've never done before. And one is that they started paying interest on bank reserves, both required and excess. They actually can charge different rates for that. I checked on it. The rate is the same right now for both required and excess. This is the rate right here going back to 2016. And that's 0.5%, 1%, 1.5%, 2%, 2.5%. So they've been driving it up. And then when they raise this rate, the rate they charge or the rate they pay banks for their reserves, they're trying to entice banks to leave more money with them. So to make it more attractive, when this rate goes up, the rate paid on reserves, both excess and required, doesn't affect the required amount, that's required, but if it's designed to increase excess reserves. And they're trying to get banks to leave more money on deposit with the Fed, therefore it's not being loaned out to you and I. Again, designed to slow down spending, slow down aggregate expenditures. When they drop the rate right here, the tone banks get your money out of get your money out of being deposited with us, go out there and lend it to people because the economy is not doing well. So on the upward side, this is when they're trying to fight inflation. And on the lower side, this is recession. And again, that was due to the coronavirus. Now, the Fed also noticed that with the Great Recession, 2008, 9, 10, that banks started to hold more reserves than ever before. You can see, going back historically, this is 1960, kind of a flat line there. You know, a little movement up and down, but not very much. Then the Great Recession hits. Actually, that little blip right there was the Y2K. What do you call that? Not Y2K? Yeah, we're going from 1999 to 2000. People were freaking out about bank accounts, going haywire, things like that, because of computer programming. And so banks went and borrowed a lot of money just in case of that. And now it used to be a really big blip there, but now it's dwarfed by this. So the Fed realized that if the economy is in trouble and they're using open market operations, open market purchases to increase bank reserves, well, big deal. Banks already have a lot of reserves. They're just not lending the money out. And that's probably the biggest weakness of monetary policy. They can increase bank reserves, but they can't force banks to lend the money out, and they can't force you and I to borrow it. So that makes monetary policy a little bit weaker, which we'll talk more about that in chapter 14, which will be the last chapter. That's the next chapter after chapter 10. So the Fed was they're trying to find other ways to help the economy. And so what Fed would do during the Great Recession, they started to purchase for the first time mortgage-backed securities. So banks had a lot of reserves, banks also had a lot of bad assets. And so what they did is they went in and took the assets off their hands, and they gave them cash. So the design was to make banks more solvent, take away a problem with these mortgage-backed securities that were failing, as people were not paying their interest on their loans, and therefore they took it off the hands of banks. As it turned out, the Fed actually made some money on this. I mean, it took a while for, I mean, these are backed by homes, even though they're bad loans, but the homes are still there. And it just took a while to find new owners for them to get the money back out of these securities. And then the Fed started to provide loans to non-banking entities. The big famous one in the Great Recession was AIG, insurance giant. They gave them a line of credit of like $37 billion. I think AIG eventually borrowed about $20 billion, and they eventually paid it back plus interest. So that was designed to prevent the failure of a giant insurance company that actually got in trouble for selling credit default swaps, which we'll talk more about in chapter 14. And then recently they started a Main Street lending program just with the coronavirus. They actually started this in May. It got off to a slow start. They first had minimum loans of $250,000, and now they dropped that, I think, in October of 2020 down to $100,000. Designed to get money into Main Street, to get money into retailers, to get money into non-banking firms. Listening to the chatter out there from the business people, these agreements are not that great. Rates are a little bit high, and it kind of has a short payback requirement. So not too popular yet. I think if the Fed makes the loans more attractive to businesses, small businesses, they'll take more advantage of them. But nonetheless, the Fed is trying new things to try to help out with financial instability, which seems to be more common now, which we'll talk more about in chapter 14. So that's the end of chapter 10.